Hello, our course of today is financial ratios.
Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements such as the balance sheet and income statement. Ratio analysis is a cornerstone of fundamental equity analysis. Key takeaways. Ratio analysis compares line-item data from a company's financial statements to reveal insights regarding profitability, liquidity, operational efficiency, and solvency. Ratio analysis can mark how a company is performing over time, while comparing a company to another within the same industry or sector. While ratios offer insight into a company, they should be paired with other useful metrics to obtain a broader picture of a company's financial health. What does ratio analysis tell you? Investors and analysts employ ratio analysis to evaluate the financial health of companies by scrutinizing past and current financial statements. Comparative data can demonstrate how a company is performing over time and can be used to estimate likely future performance. This data can also compare a company's financial standing with industry averages while measuring how a company stacks up against others within the same sector. Investors can use ratio analysis easily, and every figure needed to calculate the ratios is found on a company's financial statements. Ratios are comparison points for companies. They evaluate stocks within an industry. Likewise, they measure a company today against its historical numbers. In most cases, it is also important to understand the variables driving ratios, as management has the flexibility to, at times, alter its strategy to make its stock and company ratios more attractive. Generally, ratios are typically not used in isolation but rather in combination with other ratios. Having a good idea of the ratios in each of the four previously mentioned categories will give you a comprehensive view of the company from different angles and help you spot potential red flags. Ratio analysis types. The various kinds of financial ratios available may be broadly grouped into the following. Type number 1, profitability ratios. Type number 2, solvency ratios. Type number 3, liquidity ratios. Type number 4, turnover ratios. Type number 5, earning ratios. Definition of type number 1, profitability ratios. This type of ratio analysis suggests the returns that are generated from the business with the capital invested. Gross profit ratio, below graph. Gross profit margin. In December 2008, 56.3%. In December 2009, 58.8%. In December 2010, 59.1%. In December 2011, 57.3%. In December 2012, 58.1%. In December 2013, 2014 and 2015, 58.6%. Profitability ratios. It represents the operating profit of the company after adjusting the cost of the goods that are sold. The higher the gross profit ratio, the lower the cost of goods sold, and the greater satisfaction for the management. Gross profit ratio formula equals gross profit divided by net sales multiplied by 100, net profit ratio. Net profit margin as per the graph below. December 2008, 12.8%. December 2009, 14.9%. December 2010, 14.2%. December 2011, 14.5%. December 2012, 14.5%. December 2013, 12.9%. December 2014, 12.6%. December 2015, 8.6%. Net profit ratio. It represents the overall profitability of the company after deducting all the cash and no cash expenses. The higher the net profit ratio, the higher the net worth, and the stronger the balance sheet. Net ratio profit equals net profit divided by net sales multiply by 100, operating profit ratio. Operating profit as below in the graph. December 2008, 20.2%. December 2009, 23.6%. December 2010, 22.4%. December 2011, 23.0%. December 2012, 22.8%. December 2013, 20.4%. December 2014, 20.6%. December 2015, 17.4%. It represents the soundness of the company and the ability to pay off its debt obligations. Operating profit ratio equals EBIT, net sales 100, return on capital employed. ROCE represents the profitability of the company with the capital invested in the business. Return on capital employed formula equals EBIT divided by capital employed. Type number 2, solvency ratios. These ratio analysis types suggest whether the company is solvent and able to pay off the debts of the lenders or not. Debt-equity ratio, below the graph showing the increase from 0.25 to 2.79 during 8 years, this ratio represents the leverage of the company. A low DE ratio means that the company has a lesser amount of debt on its books and is more equity diluted. A 2-to-1 is an ideal debt-equity ratio to be maintained by any company. Debt-equity ratio formula equals total debt divided by shareholders' fund, where total debt equals long-term plus short-term plus other fixed payments. Shareholder funds equals equity share capital plus reserves plus preference share capital, fictitious assets. Interest coverage ratio, below the details in the graph comparing between Nissan and Ford companies. Blue Ford is EBIT to interest expenses annually. Orange Nissan is EBIT to interest expenses annually. Red Daimler is EBIT to interest expenses annually. Nissan has a comparatively higher interest coverage ratio as compared to Ford and Daimler. It represents how many times the company's profits are capable of covering its interest expense. It also signifies the solvency of the company in the near future, since the higher the ratio, more comfort to the shareholders and lenders regarding servicing of the debt obligations and smooth functioning of the business operations of the company. Interest coverage ratio formula equals EBIT divided by interest expense. Type number 3, liquidity ratios. These ratios represent whether the company has enough liquidity to meet its short-term obligations or not. Higher liquidity ratios, more cash-rich the company. Current ratio. Different industries maintain different current ratio levels as signified by the mature companies. Below the graph showing 0.79% for Tesco, 1.04% for Toyota, 1.27% for ArcelorMittal, 0.78% for National Grid, 1.37% for Gazprom. It represents the liquidity of the company in order to meet its obligations in the next 12 months. Higher the current ratio, the stronger the company to pay its current liabilities. However, a very high current ratio signifies that a lot of money is stuck in receivables that might not realize in the future. Current ratio formula equals current assets divide current liabilities. Quick ratio. Blue Colgate-Palmolive quick ratio annually increasing to 0.885. Orange Procter quick ratio annually increasing to 0.653. Unilever quick ratio annually decreasing to 0.882. It represents how cash-rich is the company to pay off its immediate liabilities in the short term. Quick ratio formula equals cash and cash equivalents plus marketable securities plus accounts receivables divided by current liabilities. Type number 4, turnover ratios. Theses ratios signify how efficiently the assets and liabilities of the company are used to generate revenue. Fixed assets turnover ratio. As showing in the graph below. December 2008, 5. December 2009, 4.62. December 2010, 4.32. December 2011, 4.55. December 2012, 4.55. December 2013, 4.40. December 2014, 4.23. December 2015, 4.07. Fixed asset turnover represents the efficiency of the company to generate revenue from its assets. In simple terms, it is a return on the investment in fixed assets. Net sales equals gross sales, returns. Net fixed assets equals gross fixed assets accumulated depreciation. Average net fixed assets equals opening balance of net fixed assets plus closing balance of net fixed assets divide by 2. Fixed assets turnover ratio formula equals net sales, average fixed assets, inventory turnover ratio. December 2008, 5.66x. December 2009, 5.25x. December 2010, 5.23x. December 2011, 5.61x. December 2012, 5.31x. December 2013, 5.17x. December 2014, 5.11x. December 2015, 5.18x. Lower in the last 3 years, 2013, 2014 and 2015, the inventory turnover ratio represents how fast the company is able to convert its inventory into sales. It is calculated in days, signifying the time required to sell the stock on an average. The average inventory is considered in this formula since the inventory of the company keeps on fluctuating throughout the year. Inventory turnover ratio formula equals cost of goods sold, average inventories. Receivables turnover ratio reflects the efficiency of the company to collect its receivables. It signifies how many times the receivables are converted to cash. A higher receivable turnover ratio also indicates that the company is collecting money in cash. Receivables turnover ratio formula equals net credit sales divide by the average receivables. Type number 5 and last ratio for today course, earning ratios. This ratio analysis type speaks about the returns that the company generates for its shareholders or investors. PE price of earning ratio. Blue alphabet ratio TTM. Orange apple ratio TTM. Google price of earning ratio is 47.42x. Apple price of earning ratio is 0.08x. Price of earning ratio represents the earnings multiple of the company, the market value of the shares based on the multiple. A high price of earning ratio is a positive sign for the company since it gets a high valuation in the market for M&A opportunity. Price of earning ratio formula equals market price per share divided by earnings per share. Earnings per share. Earnings per share represents the monetary value of the earnings of each shareholder. It is one of the major components looked at by the analyst while investing in equity markets. Earnings per share formula equals net income, preferred dividends, divide by weighted average of shares outstanding, return on net worth. It represents how much profit the company generated with the invested capital from equity and preference shareholders both. Return on net worth formula equals net profit divided by equity shareholder funds. Equity funds equals equity plus preference plus reserves, fictitious assets. The above mentioned are some of the ratios analysis types that can be used by the company for its financial analysis. In this way, ratio analysis is a very important tool for any kind of strategic business planning by the top management of the company. This article has been a guide to ratio analysis types. Here we discuss the top 5 types of ratio analysis, including profitability ratios, solvency ratios, liquidity ratios, turnover ratios, and earnings ratios, etc. You can learn more about financing from my channel.